Okay, we're gonna go ahead and get started. Welcome everybody to the Native CDFI Capital Access Convening breakout session for today. You're joining us for Understanding Fannie Mae's Value Proposition for Native CDFIs, and we have some wonderful speakers with us. So I'm gonna turn it over to them. We have Kelly Coffey with Fannie Mae, and she is joined by Joanna Donahoe and Mark Vanderlinden. So I'll turn it over to you, Kelly, Joanna, and Mark.
Excellent. Thank you so much, Heather, and good afternoon, everybody. As Heather had said, my name is Kelly Coffey. Ooh, seems to be an echo. Not sure. Did that fix the echo? Oh, perfect. Sorry about that, a little technical difficulty. Kelly Coffey with Fannie Mae. I am thrilled that each and every one of you have joined our breakout session today. So let me just, I'll do an introduction, but I believe I know most of you in the room. So I lead the Fannie Mae, both the rural and the Native initiatives, although I am transitioning over to another role within Fannie Mae, and I do have a colleague on the line with me today, I believe, Jose Variel. Jose, are you there?
Yes, I am. I think my video's on. Even though I wasn't prepared to be on video, but yeah, I'm here.
Excellent. I just wanted you to say hi. So over the next few weeks, Jose will be transitioning over into this space, although I'm very sad to kind of move on. I'm thrilled that Jose is going to be stepping up into my shoes. So outside of that, again, I've been in this space now for about 5 years. I'm located in the Washington, D.C. area, really close working with the tribal governments, as well as the Native CDFIs, mortgage lenders, TDHEs, and all of my wonderful partners in this space who have helped me along the way. So speaking of which, I have collaborated both with Joanna and Mark Vanderlinden. So I just want to give them a moment as well to do some introductions. So Joanna, do you want to introduce yourself?
Thanks, Kelly. Happy to be here with you today and have really enjoyed working with you on these projects. My name is Joanna Donahoe, and I'm a partner with Seven Sisters Community Development Group. And we're a national women-owned, majority Native-owned consulting firm that specializes in Native homeownership. And really excited about the great work that Fannie Mae is doing in this in partnering with Native CDFIs, and happy to be sharing some of the lessons learned over the past couple of years with the folks, not only the folks that are in the room here with us today, and with those who will watch this recording later in the future.
Perfect. Thank you, Joanna.
Hey, hi, I'm Mark Vanderlinden. I am a consultant working with Kelly and Joanna, and we've been working on this initiative for quite some time now. My background is that I have been in the mortgage business and the affordable side of the mortgage business for more years than I care to count, but the last 8 or so I've worked for HomeWise, which is the largest mortgage originator in the NeighborWorks network, and so I've had the benefit of being inside the CDFI world more recently, and then I started working with other CDFIs and other nonprofits for the last couple of years, and have worked on Native American housing issues for a couple of decades, with much of that time with Joanna, and some of that time recently with Kelly. So it's been good. Look forward to working with all of you.
Great. Thank you, Mark. Next slide. Okay, so the learning agenda, or the objectives of what our presentation will be about today, is obviously to understand Fannie Mae's role in affordable housing. I know most of you have learned a lot about who Fannie Mae is, what our role is in the mortgage industry, and how the secondary market can improve some of your capital needs, and also providing more products or tools in your toolkit. But with that, we also want to highlight and appreciate Fannie Mae's value proposition. So Mark will get into this, but we have worked with a Native CDFI 4 directions in the state of Maine to really look at what the value proposition is of offering conventional lending, not only to your tribal families and communities, but also to the CDFI itself. And it was really great work that Mark and Susan Hammond undertook. Then we're going to move on and we're going to talk a little bit about the products that Fannie Mae offers, more specifically the Home Ready product, and highlight a few of those features and benefits and how that product can specifically benefit a home buyer. And then we're going to get into a little bit of heavy logistics and talk about, how can CDFIs maximize profitability and improve your business model's sustainability. And then lastly, I think each and every one of you know how to contact and work with me specifically, but again, just talk a little bit about how you can reach out and work with Fannie Mae directly and some of the different options. So I know that this is going to be a lot of material and probably a lot of just conversation. So, and I'm not sure how much time that we're going to have. So if you don't mind, if you have questions, please enter them into the chat box, and we will kind of pause as we go because we most likely will have time in between. I'm not sure how much time we'll have at the end, so we'll be more than happy to go ahead and pause and answer any questions that you have, but just feel free to enter them into the chat box. So next slide. Okay, so I thought that this would be just a really good exercise so that we can't see who's on the line this afternoon. And we'd love to be able to know who our audience is this afternoon. So if you don't mind taking a few minutes to type in your name as well as your organization and the part of the country that you're located into the chat box so that we can get a better idea of who's in the audience today, it would be extremely helpful. So I'll just give it a few minutes and allow folks to kind of type in that information into the chat box. I'm only seeing a few names, so don't be shy. Don't be shy. Go ahead, please. There we go. We got some going. Hey, Steve and Tasha, Jamie. We've got Kathy and Mindy. Great. Thank you, everybody. We'll give it like 20 more seconds if anybody else wants to announce themselves. Thanks, Stephanie. Mark. Okay. All right. So next slide, please. We'll jump right into it. So again, who is Fannie Mae and what is it that Fannie Mae does? So I think we all know at this point that Fannie Mae is a government-sponsored entity, what is otherwise known as a GSC. Even though we have considered a quasi-government entity, I think it's really important to know that we are not the government. So we are the secondary market. And we provide that existing affordable capital and liquidity. So, and we do that through our lender partners. And in tandem with our lender partners, we make sure that our homeowners, as well as our home buyers across the country, have that continuous access to affordable financing opportunities. So again, being in the secondary market, The lenders are our partners, as well as the tribes themselves, as well as the TDHEs and the Native CDFIs are also our partners. So through our partners who will offer the Fannie Mae product, we are providing access to the low-cost, low-term capital for this mortgage financing. If these loans are met according to the guidelines that we had set forth, then we are going to purchase these loans through our lender partners, our CDFIs, and we're going to collect all of these mortgages, and we're going to sell and guarantee these loans, sell them to investors out there in what we call the secondary market. And what that does is replenishes the lender's pipeline, so there's this continuation of access to that affordable capital and liquidity. And just to put that a little bit into context, we all know that this year has just been unprecedented between pandemic and realizing the importance of home ownership and the historic low interest rates. But in the first quarter of 2021, Fannie Mae provided approximately $422 billion in liquidity. And that equated to enabling about 340,000 single-family home purchases throughout the United States. And it also allowed about 1.1 million single-family mortgage refinances. So again, we're in these historically all-time low interest rates. So we were able to lower families' interest rates, generating a lower payment. And this has continued on through second quarter. So the market for homeownership and refinancing is just, it's an amazing, unprecedented market that we're in. So next slide, please. So why should the Native CDFIs do business with Fannie Mae? You know, we are committed to making homeownership more accessible in the Native communities. Each and every one of you who know me, you know that I've been, you know, out throughout the country advocating for and in behalf of Fannie Mae. I'm just trying to complement the products that are already out there, whether it's the government products or whether it's the Native CDFI portfolio products. I just wanted to make sure that Fannie Mae's conventional products was also known throughout Indian country. So, and again, this work will continue within Fannie Mae and Jose, but we are 120% committed to continuing our efforts for home ownership, conventional lending, and wherever else that we're needed throughout Native communities. With the pandemic, it's also kind of brought some unprecedented times as far as you know, economic instability, some unemployment, some hardships in some financial situations. And this is, again, I think this is an underestimated attribute that I think Fannie Mae brings to the table, is that we help homeowners avoid foreclosure if at all costs. And I know we're not really here to talk about the foreclosures, but the point being here is that we want to be able to help homeowners stay in their homes. We want to make sure that based on the individual family's financial situations, that we have the ability to have the most appropriate workout solutions, whether that's a forbearance, meaning that you take a temporary time off of making your mortgage payments until you can get back on your feet, whether it's we have to do some loan modifications to rewrite the mortgage. I assure you that we are doing everything in our power to help homeowners in such, again, an unprecedented time in this pandemic. But again, to kind of put that in a little bit of context, that through first quarter of 2021, that we were able to execute on about 92,000 viable workout solutions that allowed families to work through their financial situations, whatever that may be, and continue to maintain, you know, their homes and their financial situations. So another strong reason to do business with Fannie Mae is that we affirm and we respect the tribal sovereignty. And we do that by entering into a memorandum of understanding. So this has been this is an important, crucial piece in being able to offer conventional lending onto tribal trust lands. We work with the tribal governments and the councils directly to enter into this MOU where the tribes, let us know what's extremely important to them. They give us information about their communities, what some of the needs are. We, in turn, also negotiate with the tribes just to make sure that we've got some strong mortgage ordinances in place. We review the residential ground lease, and we usually bring in the legal teams also to kind of talk about this. And my experience to this point is it's been extremely positive. It's been a great process individually with each of the tribes, but ultimately we do get there and we enter into that memorandum of understanding. So again, some other things that we kind of talk about through this is should we be working through a tribal court system? Where are these mortgages being recorded? What are, again, some of the needs within these specific communities? Do the tribes want to execute their first right of refusal? And anything that kind of comes up into this negotiation process. So this all kind of happens during this execution and negotiation of the memorandum of understanding. That's on the tribal side. But as far as our lenders go, and this is in protection of not only for the lenders, but for the tribes and the tribal families themselves, but we also have a special approval process in place for our lenders who want to be able to offer conventional lending on trust lands. And within this modified guidelines, it really talks about some of the specific guidelines that are outside our standard conforming work. So, and it really is geared towards meeting some of the nuances, if you will, of trust lands. So things like cost-based appraisals. So we know that supply is very limited, which means there's a smaller resale market, and most homes are new construction, and with new construction, there's not a lot of other homes to be able to compare and base appraisals off of. So we look at things like the cost approach appraisal. The latest and newest change that I'm extremely excited and proud of is the fact that we no longer mandate a title search or mandate title insurance. So this has always been a strong kind of hurdle in being able to do conventional lending on trust lands. So we will completely follow the BIA process and allow for the certified title status report. And then, as I had talked about, again, through that MOU process, we respect that tribal sovereignty, and we also make sure that we know exactly what some of the community needs are within the respective tribal trust lands and some of the tribal nations. So next slide, please. So here we're going to get into this a little bit more in deeper detail with Mark and Joanna's presentation. But again, another value proposition of what we want to talk about today is it's kind of a two-prong approach. So if our products can continue to have some flexibilities and continue to improve the borrower affordability, and if in tandem we can continue to educate, learn, listen, and understand some of the Native CDFIs products and business models, then hopefully we are creating Native CDFI sustainability. And with that, then will come that access to affordable mortgage capital. So it's almost like a three-prong approach, right? Because not only we're still trying to nurture and develop the tribal relationship, again, trying to improve the borrower affordability, and also working with the Native CDFI so that we can show and create sustainability. But for those that are visual, hopefully this was just a little visual chart. Next slide, please. So I think we're just going to take a moment here. This is actually like a 1.5-minute video, but it talks a little bit about our home ready product. I know we're looking at Mark at the moment, but if we can run the video and highlights a little bit of the home ready products, that would be great. We may have a technical, oh, there we go. Let's just give it a moment.
America's households are changing, and the challenges facing today's borrowers require a vastly different mortgage product. One that meets the needs of first-time homebuyers, people looking for low down payment options, and current homeowners looking for more affordable refinancing alternatives. That's why we created Home Ready Mortgage, a modern home finance solution for low-income borrowers that allows a down payment as low as 3% and a minimum credit score of 620. Down payment can come from multiple sources like gifts, grants, or community seconds with no minimal personal funds required. And mortgage insurance can be canceled once the borrower's home equity reaches 20%, resulting in additional savings down the road. Home Ready allows co-borrowers not living in the household and considers income from boarders and renters, all of which may help more borrowers qualify. For many Americans, getting a mortgage is more attainable than ever before. And Home Ready uses Framework, an online course that educates borrowers on the homeownership journey, making it more sustainable. Make homeownership a reality for more borrowers with Home Ready from Fannie Mae.
Perfect. So this is a question that I do get quite often is, what are some of the eligibility criteria of Fannie Mae's Home Ready product, and how is that relatable or compared to the HUD 184 or some of the products that may live in the portfolio with these Native CDFIs. So we have more products than just this one Home Ready product, but I do believe that this is probably the most advantageous product because of the fact that there are flexibilities for families at or below the 80% area median income. Again, it really gears towards the first-time home buyer, but it also allows for repeat home buyers as well if they are going to lower their overall mortgage payment. It is for purchase transactions and limited cash out refinances, but also there's this 3% down, which can be gifted or a grant or a DPA. And there's better pricing, so it's tiered a little bit based on the FICO or the credit score, which again really affects the overall affordability to the payment. And again, we're looking at flexibility and different sources of income, such as supplemental boarder or the rental income. For we know that multi-generational families can live in the home and they are contributing financially as well. So being able to use that income is always helpful. Okay, next slide, please. Okay, so I don't know, I'm going to transition the next part of the presentation over to Mark, but I wanted to pause to see if there was any questions or if anybody had anything to please go ahead and ask your question in the chat box about anything that I have highlighted this afternoon. I'm just trying to look myself. Joanna, the DPA down payment assistance, was that your note? Was there something I should highlight about that?
No, you just mentioned that an eligible use for the down payment is DPA, and I was just saying what DPA stood for in case anyone.
Oh, thank you.
Yeah.
I know, I try to stay away from the acronyms. Thank you for bringing that.
No worries.
To my attention.
It's always alphabet soup. And I'm guessing that everyone on the line knows what DPA is, but just wanted to make sure. Yeah.
Okay. Did you guys say something before I hand it over to Mark, or are you good?
Nope, I'm good.
Okay. All right, Mark, go ahead. You can take it from here.
So what we're going to talk about today for the next 20 minutes or so is kind of the results, and I would say sort of the culmination of working with this team, Joanna and Kelly and I working with Susan Hammond and her team at Four Directions Community Development up in Maine, and to just figure out what would be the value for a Native CDFI of working with Fannie Mae and a Fannie Mae lender on offering these conventional loan products to tribal members that they serve. And so in the process of doing that, this was kind of a research project for us in some ways, and became a real interactive exercise of trying to figure out how we would tailor a product specifically for one organization, and then hope that that would be replicable with others. And I think we came to a pretty successful conclusion of that. And so that's what we'll be talking about today. So I'm going to apologize also if I sound a little froggy. I think I picked up a little bug over the weekend, and so I don't have my normal voice with me today. So so the toolkit that we put together was what was the piece of this that we were hoping is replicable for other organizations, that we would be willing to provide some of the tools that we found necessary to sort of prove to ourselves that there was, what the value proposition really is for working with Fannie and these conventional loan products. So what you're going to see in the next couple slides will be some of the conclusions from some of the work that we did along the way with Susan and her team. The first thing would be a product comparison matrix, which is really just a spreadsheet. And we're sparing you having to go through the spreadsheet today because I can't, that would probably be a little rough to go through the details of a spreadsheet. But basically the spreadsheet lays out the product features and everything down to the, pricing and eligibility criteria in order to determine really for the borrower what is the best loan product for for an individual home buyer, depending on what their situation is. Would they do better with a conventional loan or one of the other alternatives that that are currently available? So that's where we started. Was let's look at this from the borrower's perspective and see what works for the borrower. The next step in that process, and basically as part of the same spreadsheet, was to determine what the impact would be for the CDFI in terms of their sustainability. In other words, what income potential, short-term and long-term, is there from using these products? And we sort of compared, again, the various product options, and sort of worked that out over time to see which things would produce a more sustainable option for the CDFI. We also developed a loan feature chart, which actually looks at sort of the underwriting and eligibility criteria, just because obviously the conventional loan products are different from government products, the HUD 184 in particular, and in rural development. And I think people have maybe some misconceptions about that the conventional standard is higher. And so maybe my borrowers aren't going to qualify. And what we determined, I think, is that there's actually more flexibility in some cases in the conventional options. Just one example that jumped out at us is that the HUD 184 program requires all collections to be paid off, and often with a conventional underwriting, you don't have to pay off all the collections. So it's just, there's some flexibility here that is not available from other products. We also developed just some framework for evaluating operational costs of operating a mortgage brokerage or correspondent lending function within the CDFI. Joanna will talk later in the presentation about different business models that would allow a nonprofit to access the secondary market, as we've been talking about. And then the last document we we put together was just really some talking points that would help the CDFI in the presentation to the tribal council, because ultimately the tribal government is going to have to sign on to the memorandum of understanding to be able to offer the product. So that's what's in the toolkit. So Heather, we can move on to the next slide. Unless there's any questions, I spent a lot of time on that slide. So I think I kind of talked about how we developed it. We developed it collaboratively with the Four Directions team, and we spent some time looking at not only the standard product options that are available, but the Four Directions has their own portfolio product. They're already a lender doing mortgage lending as it is with their portfolio product. And so it was interesting to look at the comparisons between what the secondary market products offered versus their portfolio product, and then what the long-term implications are for the CDFI. And we'll talk about that in just a second too. So Heather, we can move to the next slide. So what we tried to do from the borrower's perspective was look at a couple different scenarios. And obviously there are sort of an infinite number of combinations of these borrower traits of the folks who walk through your door every day. But what we tried to do was pick some representative scenarios to figure out which features would lead to a different result, and sort of figure out which thing would work best for which set of customers. So we looked at, at the one extreme, we looked at a borrower whose FICO score was low, but just enough to qualify. They might be low income, but as long as they have access to either their own cash for a down payment or some down payment assistance, which presumably most of the CDFIs would have access to some down payment assistance money that hopefully all of our borrowers would have access to. So, so we looked at sort of the low FICO, low income case. The next was a higher FICO, but still low income. And then the last scenario was high FICO, higher income customer, because we want to be able to serve. I'm aware that the need in Indian country is much broader than it is in the rest of the country, and the underserved part of the market also includes folks whose incomes might be higher than those who get special programs off trust land. So we looked at these three different scenarios and tried to make some comparisons of, if they looked at the HUD 184 or a portfolio execution or one of the conventional options to see which came out best. So Heather, let's go to the next slide. So we assumed that there was a roughly $150,000 sales price. Hope that's relevant. If it's low or high, you can kind of do the adjustments in your head, but the comparisons will hold true regardless of the sales price. So if that's not a relevant number in your market, this comparison still would be. And so for the borrower with the lowest FICO score, they would get a lower interest rate on the HUD 184 loan, a slightly higher rate on the Fannie Mae Home Ready product, which they would be eligible for, but still not as high as the estimated rate. It's probably within some degree of error what the portfolio rate was. And so the lowest payment option turns out to be the HUD 184. The Home Ready was a little bit higher, but in both cases much lower than the portfolio execution. The interesting thing I thought here was when we looked at what the minimum qualifying income was, it's still lower for the Home Ready borrower. So a lower income borrower might actually be able to qualify for a conventional loan and not qualify for the HUD 184 or the portfolio loan. And there's some reasons for that if people want to kind of dig into that a little bit, but it is a different way of qualifying borrowers. And so one thing that popped out here was that the HUD 184 program has a maximum housing ratio and a maximum debt ratio, and the conventional option only has a higher debt ratio. And what that really means is that for a borrower who has minimal debts, they're going to do better with a conventional. They'll qualify for more under a conventional loan than they would under even the HUD 184, even if the interest rate's lower on the HUD 184 loan. So, one thing that just kind of jumped out at us, even in this case for a borrower with a low FICO score. So we can go to the next option. So this was the borrower whose FICO was a little higher, but they were still low income, so they qualified for Home Ready. You'll notice that the interest rate on the Home Ready loan just got lower. It was 3.375 in the last example. Now it's 3.125, and that happens with the conventional loans. There is risk-based pricing, and so the borrower with a higher FICO score gets rewarded with a lower interest rate. And as a result, you will see that this borrower has a lower payment, $833 a month versus $860, qualifying income quite a bit lower than it would have been with either of the other two options. So clearly we're seeing that the conventional loan for a borrower whose FICO score is a little bit higher comes in with a better borrower execution than they would get from the other loan products that are available. And then the last example we looked at is a borrower who is higher income. So Heather, we could go to the next one. And so in this third scenario, this borrower actually doesn't qualify for Home Ready. We should have changed the description up there in the top. This is a regular old Fannie Mae standard mortgage, and they actually had again a lower payment than they would have had with the HUD 184 loan. So I think that was in some ways sort of a surprising result to us, that we had a lower payment option. And what drove that was that we're using some down payment assistance money for directions. So instead of them putting up all the money under their portfolio option and loaning the borrower 95% or 100% of the $150,000 sales price, that they were only using their money for a 10 to 20% down payment assistance loan behind a conventional mortgage. And in doing that, they eliminated the monthly mortgage insurance, and that's how we got to a lower payment than we would have had on even the HUD 184 as compared to the conventional options. So anyway, that was our big takeaway, was like, okay, well, thing number one, borrower does better under certain scenarios with a conventional option than they would under the under the existing government program or the portfolio product. This might be a good place to take a pause and see if folks have questions before we move on to the next section.
Mark, I have a question.
Thank you. Go ahead.
So you mentioned in the little video, they talked about more private mortgage insurance and needing private mortgage insurance if you have over 80% loan to value ratio. How does mortgage insurance play into these scenarios and affordability?
Right. So it's a huge factor with the conventional loan. So the HUD 184 loan, they don't call it mortgage insurance. It's the mortgage guarantee fee. And with HUD 184, there's a piece of it that gets added onto the loan balance, and then the rest is part of the monthly payment. But the part that's in the monthly payment is fairly low. With most conventional loans, lenders are charging that to the borrower as part of their monthly payment. And the conventional mortgage insurance tends to be more than the HUD 184 is. But when you use down payment assistance, as we did in these examples, where we drove the loan to value ratio down to 80 or 90%, at 80%, there's no mortgage insurance required. At 90%, it's just cheap mortgage insurance. And so with that high FICO example, we actually used, there is a little bit of mortgage insurance on that, but we financed it in the first mortgage. So, there are ways that CDFIs in particular, because you have access to down payment assistance money, can deal with the mortgage insurance creatively by reducing the LTV of the first mortgage and reducing the impact or eliminating the mortgage insurance entirely. So did I get to what you were asking about, Joanna?
Yes, thank you.
All
So
right.
it's the 80-20 rule.
It's the 80-20. Yes, this is a version of the 80-20 rule. That's right. Yeah. So right. So they always have to have mortgage insurance if it's more than 80%. If it's only 90, then you've got options. We found a way to use the CDFIs money in a way that really limits the impact and actually is the lowest payment option of any of these options.
Awesome. Thank you.
Okay. All right. So the last part of this analysis that we did for 4 directions was to look at what the long-term implications were for the portfolio. And again, this is like there's a lot of variables here. Determine what the CDFI's cost of funds are, how much capital they need to raise. And so rather than going through all that, I thought it would make more sense for us to just talk about the principles involved. And hopefully this will make some sense. But the ultimate sustainability that lenders get out of working in the secondary market is just this access to the low cost capital. And it's essentially an unlimited source of low interest rate affordable capital. And so it provides the liquidity to serve more customers and reduces the need to raise all that lending capital that you would need if you're doing all portfolio lending and you have to come up with the entire first mortgage amount for every borrower that you're trying to serve. So through this example that we worked on with 4 directions, we're multiplying the use of that scarce resource of their own capital 4 to 5 times. They can serve. Actually, it's more than 5. It's anywhere from 4 to 10 times more customers that you can serve with the same amount of money. So it's a huge multiplier for the organization to use the secondary market. But it does change how the organization gets paid, right? So in selling the loan, they're going to wind up getting paid the money at the time of loan sale, as opposed to earning it over the life of the loan. And so the lender's going to earn the origination fee, a premium on the sale of the loan, hopefully, and potentially get paid also for the servicing. Even if you don't do the servicing, you can get paid for selling the servicing. So we'll talk about that again in a minute. And the other piece of this that's interesting is that there is still some residual income that comes back to 4 directions in this example because they're doing a second mortgage. And so they continue to get paid that money over the life of the loan. So it's maintaining that portfolio. And the thing that I love about second mortgages is that they perform like the underlying first mortgage. That is, if the borrower is going to make their payment on the first mortgage, they're going to make the payment on the second. And the second has a slightly higher interest rate. So it works very well in your portfolio to have second mortgage, well underwritten second mortgages in your portfolio. So Heather, there we go. Thank you. So we talked about the fee income that you can earn from selling the loans. And the question is like, well, is the fee income that I get from selling the loan better than I would have gotten if I just kept it in portfolio? Well, that depends. It depends on a whole lot of other stuff, right? It depends on how much you were going to make if you held it in your portfolio the whole time, as opposed to the fee income that you get up front. So that depends a lot on how much capital you have to borrow, and what the terms are of any of those, of any of the funds that you're borrowing. So If it's in portfolio, you're earning the spread over time, but limited upfront cash. All you're going to make upfront is the origination fee, and that's all. And then you're, hoping that the loan performs well and stays on your books a long time, so that you earn that fee income over the life of the loan. And again, depending on what your cost of capital is, and also, if you're making 30-year loans, but you have only the ability to borrow money for 5 years or 10 years, there's some risk associated with that as well. Combining the conventional 80% mortgage and a 20%, a conventional secondary market sale of 80% and keeping the 20% has the ability to generate some income over time, but massively increases your liquidity and sustainability by generating the fee income up front, but replenishing your capital quickly. I think that's the key thing. And the real answer is you serve more customers. And that's how you make up the difference, is by serving more customers and earning a fee for serving more customers. So, Joanna, are you taking over at this point, or have I got one more slide to do before you take over? This is my last slide, correct?
But I still have another question for you.
Oh, you do? All right, before we do the last one. All right, go ahead.
Okay, well, I was just going to ask, I get this question a lot, that everybody keeps saying the secondary market provides an endless supply of liquidity, and it helps with capital, to access capital, right?
Yeah.
So when you get started, though, that's once you sell the loan and you replenish the capital. But when you get started, if you don't have enough capital on your books to lend, where do you get the capital?
So there is short-term money available to fund mortgages that you are going to keep on your books for a very short period of time while you are selling to a secondary market entity. And this can either be just kind of a plain old line of credit from a bank, or specifically a warehouse line of credit that you would typically also get from a bank. And that's basically that's all a warehouse line of credit is a line of credit. So it's just something you go borrow the money on a short-term basis. But warehouse lines of credit are specific to the mortgage business, and they tend to be much cheaper than a standard line of credit because there's pretty low risk involved when it's a mortgage that you're only going to have on your books for, say, less than a month. The first payment isn't even due. So the lender knows that this loan is going to get sold, and they just have to hold it for a short period of time. So those tend to be really low rate. When Joanna starts talking in a moment about different lending options, for most of the native CDFIs that we've been working with, the first option of getting access to the secondary market is brokering, as opposed to closing the loan in your own name. And as a loan broker, the lender that you're ultimately delivering this loan to will fund it. And so you really don't even need your own capital in order to do loan brokering. So it's only when you start having to close them yourself, and I'm saying have to, I should say when you get to, because typically you'd earn more by closing the loan yourself and selling in the secondary market directly. But loan brokering takes care of that same problem you're talking about, Joanna.
Awesome, thanks.
Okay, thanks. So the additional benefits of the conventional lending option. So we've talked about the economic arguments so far of can be a better deal for the borrower, can lead to more sustainability, can lead to serving more customers. But the additional benefits to the tribe or to a tribal entity that we've discovered in all the research that we've been doing is that we think that the tribe or the tribal entity has more control over the process, particularly if there's a problem. If the borrower starts to get into trouble with being able to make their payment, that there are more options with the conventional program than there are with the others. We certainly are going to enforce that mortgage in tribal court. It's not going to go into the regular, county court system that all the other mortgages go into. The MOU process allows the tribe to have a right of first refusal, which means you have more control over who winds up buying that property if it has to be sold, if it has to be sold to another buyer. And a few more options Kelly was alluding to earlier in terms of customers who may need modifications or other flexibilities in order to stay in the home. So we think that there are some non-economic benefits as well to doing the conventional options. So at this point, I will hand off to Joanna, who's going to take it from here.
Awesome. Thanks, Mark. But I do want to just ask if anyone else has any questions for Mark about this process. I know Mark's been doing this for a long time with his CDFI. So, and there are many other CDFIs who do the same thing. They just aren't as prevalent with native CDFIs, but that's all changing. So you can either type a question in the chat box or come off mute and or raise your hand and ask your question in person. But until someone does that, I'm going to keep rolling with our slide, because this slide has a lot to unpack, but this is really a process slide. So Kelly told you a little bit about Fannie Mae and who Fannie Mae is and what their product, the Home Ready product. Mark talked about some of the benefits of conventional lending and why, the proposition value that we found through our research and with working with 4 directions. Now I'm going to talk about how it actually works. And I see, let me just go ahead and answer Shayna's question, because that's a great question, Shayna. Would the tribe still have to enter an MOU if the credit union isn't tribally chartered? And the answer is yes, because what the MOU does is the tribe gets together with Fannie Mae, and Fannie Mae is actually reviewing the tribal laws, the ordinances, to say, yes, okay, these ordinances provide all the safeguards that our lenders need, including the credit union, if the credit union is the lender, and it provides all the protections and risk mitigation processes, and so we'll follow tribal law, and the tribe has the ability to put in to discuss what they require, what their needs are during that whole process. So what the purpose of the MOU is to signify that conventional lending can occur within that tribe's jurisdiction. So let's say a financial institution, even the credit union, Lakota Federal Credit Union, if you were making loans off reservation, you wouldn't have to have an MOU in place because you were working in the state jurisdiction. But while you're working on the reservation, that's within the jurisdiction of the tribe. So the MOU signifies that, yes, this is an approved area for business, for the conventional lending business. So hopefully that answers your question. And that is the first step to this whole process. It doesn't have to be the first step, because there's a lot that the CDFI does to get ready for this process. But the tribe, in order for any loans to happen within the tribe's jurisdiction, they need to enter into the MOU. And that's usually an education process where, as Kelly said, Fannie Mae's attorneys work with the tribal attorneys, and it's kind of a back and forth discussions until everyone gets comfortable. And recognizing and working with the tribe. In many cases, if you're already in that jurisdiction, you're already doing 184 or 502 lending with USDA, everything's in place, but it might just be a minor a minor amendment to the tribal code to allow conventional lending. So it doesn't have to be a long drawn out process, but it's really a great process to establish that relationship between the tribe and Fannie Mae. Then Fannie Mae also educates their lenders about the lending process on trust land. So when we talk about Fannie Mae approved lenders and Native CDFIs, I'm going to talk about how they work together. But the Fannie Mae approved lenders are the ones who actually are approved to be a direct seller servicer to Fannie Mae. So, but the Native CDFI still has an important role to play in partnering with those Fannie Mae approved lenders. But Fannie Mae has been doing a lot of outreach and discussions with their own tribes and has created the variances that Kelly talked about at the beginning of this slide presentation. So that's the kind of MOU process. Then when you get to the next, the red section of the chart, we look at home buyer prep. And that's something that you guys are absolutely, the Native CDFIs are so fantastic at, and why Native CDFIs are such a great partner in this space. The tribe will issue the lease if it's on trust land, and they'll govern, whatever the land situation is, whether it's fee, trust, or allotted. The Native CDFI then does the homebuyer education, and in some cases they'll make the second mortgage to negate the need for mortgage insurance, as Mark talked about, and then we'll also help the family, the borrowers, to decide whether they want to build or buy, or if they want to use some type of manufactured housing product, or work with a contractor, or buy a home and renovate it through the application process. So it's all the normal stuff that a Native CDFI is already doing now. And then once you come to the lending process, the family applies for a loan from a Fannie Mae approved lender, and as I talked about earlier, the Native CDFI may have a role in that, and that's what we're going to talk about in terms of the different business models that you could participate in. The lender or the broker, if you're the Native CDFI serving as a broker, well, the lender approves the qualifying borrower, and then the family builds and buys the home. So that's the normal lending process. And a CDFI could be inserted in that process. As I said, that's what we're going to talk about. But then here's the cool stuff. Here's where the magic happens. Here's where the capital and the liquidity comes into the scene. The lender, because that loan that they have made is a conforming loan, meaning that it satisfies all the requirements. And usually when you work in Indian country, you say, this is not a cookie cut. We can't use a cookie cutter approach here. This product is a cookie cutter approach, but it's a good cookie cutter that works in Indian country, as Mark has explained. And the benefit of using that conforming or cookie cutter approach is that the investors know it's got the good housekeeping stamp of approval. Fannie Mae, this is a Fannie Mae loan. We are going to bundle up those loans into one little basket, and we're going to buy those loans, and we're going to provide capital and investments. And those investors may be from all across the world. And that's where the magic happens, that liquidity. So once the loan is sold, the lender as the loan is sold, the lender decides whether they're going to retain or sell the servicing rights. And there's lots of pros and cons to that, depending on their structure and their capacity. But and then also that's where the income comes in, as Mark said. And then Fannie Mae has, provides access to the liquidity. So that's the process that happens. It's very similar to the government guarantee program process or the portfolio process, but there's these extra steps in there that that have all the benefits that we've just talked to, that create all those benefits. So that's what happens. Let's go to the next slide. And let's get into, Heather, the next, let me stop there and we're going to do this poll. So I know there's a mix of folks on the line, but we're going to do a quick poll. So if you have a cell phone, you can just use your QR code reader. If you have a cell phone with a QR code, you can just take a picture of the QR code, and the Mentimeter poll will pop up. If you don't have a QR code reader in your phone, you can just click on the link that I just put into the chat box, and that'll take you right on your computer to do the poll. It's a quick 3-question poll. It's really geared towards native CDFIs. If you aren't a native CDFI and you'd like to still do the poll, please do, but just answer it as if you were a CDFI that you're partnering with. So if you are a CDFI, answer the questions. There's 3 quick questions. If you are not a native CDFI, but you work with a CDFI as a partner, you could answer as if you were the CDFI that you're partnering with. We just want to get folks' perspective on some key questions about this work. And so I'm going to share my screen as you guys are doing that. So Heather, if it's going to stop sharing for you, but let me go ahead and pull that up for you guys so we can see what folks are saying. So I'll give you a little more time to do the poll. Does anyone have any problems accessing the poll? It's really simple. Totally, it's a very simple poll, so don't be stressed out by it. All right. Okay. Give you just one more minute. Our first question is, how likely is your tribal council to enter into an MOU with Fannie Mae to bring conventional lending to your tribal jurisdiction? All right. With a few productive discussions, they will see the benefits and will probably sign the MOU. 20% of you guys said that. 60% of you said, this will be a heavy lift. We'll need to educate them a lot. No worries. I think that's the case with many tribal communities, and it's not a problem. It's just a matter of taking the time and getting to finding the right advocates within council and having the right information. And that's part of what the toolkit is that Mark talked about earlier, having those talking points and being able to share that information with council. 20% of you guys said you have no idea. That's always the case. Sometimes, policymakers at any level can be a little bit uncertain as to how policymakers will approach a particular issue. Okay, let's go to the next question. How would you rate the value of the following benefits of conventional lending? No question. What folks said was the highest value is access to capital and liquidity. Borrower affordability and CDFI sustainability is the next highest, and then ability to settle disputes in tribal court is next. So yeah, so all of these are benefits, and obviously that magic sauce, the secret sauce, the magic, where the magic happens with that capital and liquidity, that's really key. The issue with tribal courts, I think in some cases as of late, I mean, obviously the preference is to stay out of to any court, no matter what jurisdiction, right? And so the issue there is that we need to look at, staying out of any court. But as of late, some of the 184 cases have been in federal court, which can be challenging, or it's hard to be in. You can't be in county court or local jurisdiction in the state if it's a tribal jurisdiction. So, obviously the preference is to stay out of any court. Okay, let's look at our last poll. Last question. And we're asking here, what's the biggest hurdle, the single biggest hurdle? So licensing. Well, that's good news to hear that you guys think that's the biggest hurdle, because that's the easiest one to overcome. That's awesome. So licensing, yes, that can be a challenge. It can be daunting, but it's definitely easy to overcome. CDFI staff capacity, borrower readiness, and finding an aggregator. Yep, those are all challenges, but actually none of the things on this screen are insurmountable. But it's just interesting to see people's perspective on what they find a challenge. Okay, so thank you guys for doing that. I'm going to stop sharing And Heather, well, if you don't mind putting your slides back up. Any impressions from that poll? Anything anybody was surprised about from the poll? About the barriers or the benefits? Mark, did anything surprise you?
Sorry, trying to find that mute button.
The mute monster.
Yeah. Well, I think the same thing that you reacted to was licensing. I think that's it's an intimidating process at first. You know, you read all those requirements and you go, oh my gosh, how much time is this going to take and all that. But it's the best thing about it is you really only have to go through it once, and then you know, from that point on, it's just you know, the renewals are fairly simple to keep up with annually. But yeah, it's a surmountable problem. And all the others are fairly standard, right? Just, you know, borrower preparation, you know, it's just that most of the rest of that's kind of blocking and tackling, I think, right?
Yep.
That's what we do every day. Yeah.
Okay, thanks. And Becky mentioned in the chat box, I thought the borrower readiness might be higher than that, the challenge with borrower readiness. And, you know, I got to say, it depends on where you are and the relationship that the Native CDFI has and you know, what they're like. I mean, for Native CDFI housing lenders, I mean, that's what they've been spending a lot of time working on. And, you know, I think you've seen over the past, I don't know, 5+ years, certainly since Duty to Serve, Fannie and Freddie have done a lot of paid a lot of attention to the investing in especially Fannie Mae investing in the capacity of the institutions that are doing this work. And so there's been a lot of capacity building in the area of institutions that are supporting borrower readiness. So, but then if someone is just starting out, they don't have that infrastructure in place. And really it's the boots on the ground, those local partners who are doing that work that make the difference for borrower readiness. But there are so many tools out there now, you know, curricula, the Pathways Home curricula and other materials that are, and a lot of stuff is going online now that are really helping to improve borrower readiness. So, okay, so how can a Native CDFI get into this game? So we've alluded to some of these things, but we wanted to spell them out directly so that you had a sense of how Native CDFIs fit into the picture. So obviously you can be a broker, and a broker is really someone who is kind of an agent of the lender. And yes, it does require for an institution to be licensed as a broker, but you're not lending your own money as a broker. A correspondent lender, you are lending your own money, but you're working with an aggregator. You're not a Fannie Mae approved lender, seller, servicer. So a correspondent lender works with an aggregator who is a Fannie Mae approved seller. So, or once you have more capacity, once a Native CDFI has capacity, can become approved by Fannie Mae as a seller or servicer. And there are other CDFIs who have done that. It's not easy. Many of them are regional, but it's definitely something that a Native CDFI can aspire to do. It just takes capacity and takes scale and takes time and staff to do that work. So you'll see the majority of folks starting off as brokers and correspondent lenders. So we're going to go through each of these. Heather, if you go ahead to the next slide. So what exactly is a broker? So as I said, you do have to obtain an NMLS license. And that's really, you know, it's not, as Mark said, it's not a hard thing to do. It just takes time and the right staff who becomes, both the entity has to become licensed and the staff. And many states, and it's by states, there's a national website that you can look at. But each of the states' requirements are different. And many of the states will waive the licensing requirement for the individual if you're a nonprofit, which is great. But the individuals still have to have their brokerage license. So So that's the first step. What does the broker do? Well, they actually take the application and gather the loan docs. They might order the appraisal, the credit report, the title work, all things that Native CDFIs do already if you're a housing lender. You might distribute the disclosures and get some signatures, find down payment, maintain the customer communication through the loan process, and complete the processings. But you submit it to your lender partner's underwriting, and you earn a fee for that. So you're actually negotiating a contract with the lender, a brokerage agreement, and that will define what you do, what your role is as a broker, and how much money you get paid for doing that. But the key here is it's not your capital. You're not lending your capital. You're lending other people's money. But what's great about it is that you have the relationship with the lender, you know your community, you've educated your borrowers, and you can really get the application together and understand what the lender's requirements are, and then get paid to do it. So it's more involved than being a loan packager, but it's even more involved than just making a referral. So it really helps you to provide that bridge to capital if you don't have it yourself to your borrowers. So that's the broker. The next slide is that correspondent lender, and that's sometimes called a third party originator. So if we go to the next slide, they do all the same things at a broker, but but there's some extra steps. So all the compliance requirements, the verifying fees, borrower cash required, all of the compliance, ordering the title policy, and on trust land, the title search goes through the BIA. As Kelly said, you don't have to go through the county records because that doesn't make sense. But if your land is recorded in the BIA's Land Title Records Office, that's where your title search is, but you don't have to have title insurance because that's a federal document. You can order funds from the warehouse line. That's what Mark was talking about earlier. That's what you get your capital to lend, and then it's a short-term line of credit. You close and hold the loans for sale to the investor. You may start establishing a quality control program, which is how Fannie Mae ensures that you're using that cookie cutter approach, that conforming loan approach, and you would then earn an origination fee and some servicing release premium if you're selling your servicing rights. So a lot of institutions, a lot of Native CDFIs, they want to be sure that whoever does the servicing is someone who understands the market. So that's an important thing to think about as well. But this correspondent lender is it's their own money, they're lending, they're just not selling it directly to Fannie Mae. They then go through an aggregator. And what's nice about that is that the aggregator or the Fannie approved lender, they may have access, they may provide you access to the loan origination software, the desktop underwriting, and those types of things. So that's a correspondent lender, and that's what many Native CDFIs will aspire to do, because the benefit to this, you're lending your own capital, you're making the decisions, and you're actually underwriting the loans and then working through a conduit. So next slide, the Fannie Mae approved lender. So these are the guys that actually they are, the buck stops with them. They obtain the approval from Fannie, they deliver and sell the loans to Fannie, and they earn their original fee plus the premium of the sale of the loan. If it's service release, they earn an additional upfront fee. So the pricing on these entities and on these transactions depends on where you are in the food chain, but that also the more capacity you have, the more power you have, and the more ability to generate revenue. But there's so many entry points into this process. So it's all right, you can go ahead and go to the next one, the servicer. So as I mentioned earlier, the servicer, we definitely want to understand that the servicer can be different than the lender, and they may have their own licensing requirements, and they're the ones that take the money, the payments from the borrower, and they're the ones that set up the escrows, and servicers have been very busy during COVID in answering lots of questions about, borrowers who are having challenges. They are involved with loss mitigation, and they handle foreclosure if necessary. Obviously, that's the last resort. We want to avoid that. And then again, that goes back to the MOU. So wherever you are in the food process, the food chain, you're following the tribal laws. So that's why it's important that Fannie educates their entities, their partners, on doing business on trust land. And that's why quite honestly, the Native CDFI is involved in these. The more they're involved in the transaction, no matter where it is in the lending process, the better it is. So Mark, let me just ask you if there's anything you want to add to any of these roles, because this is what you live and breathe.
Right. I would just say that the sort of the general principle at stake here is that the more functions that your organization is capable of performing in this process, that's just more reason to get paid, and it just enhances the organization's sustainability. And from sort of my personal experience in this, nobody knows your customers like you do. And so to the extent that you're providing that service at your level, it's probably being done better than it is if it's outsourced. And so it's one of these wonderful alignments of interests that happens in our business, that sort of the more we take care of the customer, the better it winds up being for the organization. That the better you're taking care of the customer through each stage of the process, you're getting paid for doing these different functions. And just one example would be, so in this current environment with these super low interest rates, and our customers in this space, right? Whether they're on tribal land or off, are probably going to stay in this house longer than the mortgage market expects them to. And so when you sell the servicing to someone, you're probably not getting paid as much for it as if you did the servicing yourself, right? Because they're gonna assume this loan is gonna pay off in 5 or 6 years, and so they'll pay you for like 5 or 6 years worth of servicing, when in reality your borrower may stay in that home for 15 or 20 years, right? So if you were capable of being the servicer, you would make more money doing that. Well, I bring that up because I just, back to my other point, I think the more of these things you're capable of doing, the better your customer is served, and the better sustainability is for the organization.
Awesome, thank you. So I think our next slide is just is moving into Q&A. So Heather, let me just yeah, those are all the slides. So we're moving into Q&A. So I wanna, of course, have folks ask their questions, and then I've got some more questions as well. So Steve, I see your smiling face. Hi, Steve Barbier from NeighborWorks. Nice to see
Joanna,
you.
great to see you. And I want to thank everybody. This has been a fantastic presentation. And Mark, Joanna, Kelly, and I do want to say that Kelly, we're really going to miss you. You've done an amazing job at the time you've been in this role. You made great progress, and I see a lot of that progress has been moving the conventional product more in line with some of the good features of the 184 loan product. And along those lines, and I think we saw it in the poll, this MOU piece is a big lift with tribal governments, and I know you know that. And I would ask, and I'm doing this in part for Jose, since he will be our partner going forward, I would ask that Fannie Mae take a close look at the interagency agreements that are used as models and are readily used even today, sometimes with modifications, but to look at how Fannie Mae could be added to those existing agreements rather than creating new MOUs and new leases. I think that would be a much easier lift for a Native CDFI to try to meet with, the tribe's legal staff and just say, hey, we can make conventional financing available just by adding Fannie Mae to our existing documents. So that's an ask I would make. I know we talked about that some time ago, Kelly, and and I know the legal staff is very busy at Fannie Mae, but we've seen the need for this. In some ways, just about every year there's a blip within the 184 program. It's around lending authority and dear lender letters. And having a conventional product available, in these markets would be tremendous. So that would be my S. And thank you again for all your hard work.
Steve, thank you so much. That really means a lot to me. I really appreciate the recognition, and I'm extremely sad to go, but I'm leaving you in good hands with Jose. And I'm still within the organization, so I'm certainly not going anywhere. I'm going to work in tandem with Jose probably over the next month or so. So certainly feel free to continue to reach out to me, should you need to. Just two clarifying points on that. I do want to talk a little bit about, by no means is Fannie Mae saying it's the Native CDFI's responsibility to educate the tribal council and the government, right? I mean, it certainly helps when we can partner and work in tandem, but that is certainly an effort that Fannie Mae has committed to and has been extremely dedicated in doing, and will continue to do that. So that's the benefit. I think another benefit is that, these tribal communities have this relationship with Fannie Mae where they can pick up the phone or email, directly to Fannie Mae and work directly. So I suspect that, Jose will continue to, advocate to the tribal council, meet with the board of directors, continue to, educate as necessary. So by all means, that's certainly not being put on on the plate of the Native CDFIs. Certainly, if the Native CDFIs can advocate and they become a trusted partner and together we're working together, it certainly makes the process a little bit easier. But again, it's always going to be the lift of Fannie Mae to establish those tribal relationships. And then, yes, we did talk about, standardizing or having Fannie Mae kind of add on to some of those industry kind of documents. The one thing that I will say is that, at least as it pertains to the residential ground lease, right, we're certainly not asking that any changes be made to the ground lease. What we do for that particular issue is that we ask that a rider, right, is attached to that ground lease. So, and again, it does have to be reviewed, and it does need to be accepted on behalf of the tribe. So that in one sense, hopefully makes that process a little bit easier, that Fannie Mae certainly not asking for any changes to a residential ground lease, but adding that lease rider to that hopefully solves a little bit of the issues. But you're right. Legal's been really kind of busy to kind of look at some of those other documents as well, but we can certainly continue to get on their roster. And to Joanna's point, I think she made this earlier, is that for the most part, if a tribe has already been approved with the HUD 184, and we've seen most tribes kind of just accept the one-stop shop, right? Usually, Fannie Mae was huge in that process as well back in the 2000s, that there's very little changes that need to be made to these ordinances and things like that. Granted, a lot of these ordinances are directed towards the government products, and as we know, Fannie Mae is not a government, so there's little minor tweaks and things like that, just to make sure that all of the products are all encompassing, both conventional and government. But other than that, I mean, some of the work that we've done with the tribes and some of these ordinances that I've seen have not been completely, completely so cumbersome that it took a long time to kind of rectify. But we're always open to streamlining our process to certainly, again, this kind of falls in, if we're going to respect the tribal sovereignty, this is definitely something that we have to continue to work on and enhance. And we're certainly willing and able and committed to do that. So just a little update to Steve, but certainly still have some work to do in that space for sure. So thank you for raising that.
Thanks, Kelly.
Yeah, and it looks like so anyone that has questions for Mark or myself or Kelly, please do either type in the chat box or let me know. But I see there's Wisconsin is in the house. There's a couple of native CDFIs here from Wisconsin. So I know you guys have been working hard at your mortgage products. Also, folks, we see Oklahoma, Citizen Potawatomi Nation, and Navajo Partnership, or sorry, I still say Navajo Partnership for Housing. It's Native Partnership for Housing. So I know many of you guys have already been looking at this. So do you guys have any questions, or kind of if you want to share kind of where you are in this process? I know that a first step for many of the native CDFIs has often been becoming a packager. I mean, either you're already doing your own portfolio lending, but many start with becoming a packager because then you get familiar with other products, even the government products. 502 packaging is a good first step, and then moving more towards becoming a broker. And the experience with conventional government lending is really important, but it's just it's an easy next step then to do this type of work for conventional lending. So, oh, and I didn't say Shana too. Shana from from Lakota Federal Credit Union. So we have the whole country, a lot of different corners of Indian country represented on this call. So, and a lot of other great partners. So I'll just share also that the work with Four Directions continues. They're a longtime native CDFI housing lender, and they have some great relationships with all the tribes in their state, and moving forward with the Penobscot Nation, because that's where there's a lot of mortgage lending happening. So moving forward on that front. So we'll have, I don't want to say they're a pilot, because there are many other communities that are doing this work as well, but this is the first community that Fannie Mae is kind of really digging into the value proposition. Okay. Also, just going back to Becky's point, Becky, I think you raised a good point about homebuyer readiness. I mean, let me just ask every other folks on the line. Are people feeling like homebuyer readiness may be more challenging for the conventional market? And maybe Mark, maybe you can help address that question, because I know you have said many times that the HomeWise model has really tackled homebuyer readiness.
Yeah, that's kind of our thing. Is there's a lot of these little slogans around the building, but one of them is nobody's born with a bad credit score. And in HomeWise presentations, we often have a slide with a bunch of, it's a maternity ward, and instead of their names, they have a FICO score at their foot. I love that little slide, because it's a very great visual of, it's not predestiny, right? When somebody walks in your door and they're not mortgage ready, that's not an answer, that's a beginning point. And so what our organization has really worked on has been, really working with customers at whatever level they're at to get them to the point where they are mortgage ready. And there is this notion, and there is, I'm sure, some truth to it, that the conventional product has a somewhat higher credit standard, but it is only a minimum 620. It's just a 620 FICO floor is the actual minimum. And I think what, kind of the next step in the evolution of this process, I think is going to be to try and get the tool, the Fannie Mae desktop underwriter tool, into the hands of more native CDFIs, so that they can actually run a borrower scenario, pull the credit into desktop underwriter and see how it goes. Because I think we're going to find out that many more borrowers are actually eligible than we think are eligible for a conventional product. And I mentioned earlier about just the collection issue, because desktop underwriter will come back and tell you if the borrower needs to pay off collections or not pay off those collections. And with HUD 184, it's automatic. I mean, so there were just, a number of sort of surprising things in there when HomeWise made that move to using desktop underwriter at the point of counseling, at assessing the borrower's financial condition before even working with them on a path to home ownership. So,
awesome.
Yeah,
that's awesome. Thank you so much, Mark. And I know we are at time now, so
yeah.
hopefully, Kelly, Mark, and I have done a good job of showing the value proposition and kind of open some eyes and some minds about the conventional lending experience. And I know we're getting ready to head back to the plenary session, but Kelly, any closing thoughts that you'd like to share? We're really going to, looking forward to it, very excited for your next step. We're definitely going to miss working with you.
Oh, thank you so much. No, just thank you everybody for your time this afternoon. You had some options and sessions to choose from, so I appreciate you sitting in on ours and learning again about Fannie Mae and some of the options that we are trying to provide to Indian countries. So thank you everybody, and of course a huge thank you to both Joanna and Mark. I couldn't do this work without their partnership, and they've just been extremely valuable to me, to Fannie Mae, and to this work, and to Jose in the future. So, and then of course to OISTA, who's always just been a wonderful partner. So again, thank you for allowing me to speak at your conference today. We really appreciate it. Thanks you, everybody.
Yeah, thanks everyone. And Heather went back to the plenary to get ready for that session, and which starts at 45, so 2:45 Mountain. So I invite you guys to go back there. There's gonna be a state of the field presentation about Native CDFI industry data. So thanks everyone.
Thank you. Enjoy the rest of the conference.
Thanks, Tasha.
Well.
Bye-bye.